guys, and welcome to the last lecture for this part of the syllabus, responding to the risks of material misstatement. And we're doing that at two levels, at a financial statement level and an assertion level, and then the response at the assertion level is going to be the audit plan. Okay, so everything we've done to date is so important in coming up to this response, because we've got to use all the information we gathered about the client, all the planning work we've done so far to help us determine how we want to respond to the risks we've picked up. Before we go and have a look at the psycho knowledge levels, I just want to do a quick little school hack with you. While studying for a certain subject, pretend that you have to teach the material, because it helps you pay more attention. So while you're going through this work after having watched the lecture, pretend you're teaching someone who doesn't know auditing how you determine the response and what your audit plan is going to be, because it's going to help you to make sure you really do understand, because you will not be able to teach something you don't understand. Okay, so just another little trick, a little tip. Use it, don't use it. But I find you guys need lots of tips. I need lots of tips in the day-to-day running of my life. You need lots of tips when it comes to CTA. Just some basic practice that you may forget in the fluster of this year. Okay, let's go have a look at the knowledge levels. It's week 4. And we are responding to the risks of material misstatement, the risks that we identified last week through understanding the entity, and we identified them at those two levels, the financial statement level and at the assertion level. We now have to respond at both levels, and that is why we developed the audit plan to respond to them specifically at the assertion level. ISA 330 is the auditing standard that we're going to look at. It is a single lecture, guys, so there is time for a question, and so we are going to be doing mock test 4 MTWC, which you'll find in Cole Campus. Okay, let's just have a look at the knowledge level required for ISA 330. We're going all the way down to responding, which is addressed in week 4, to the assessed risks of material misstatement, ISA 330, and it's a level 3. So you need to know how to develop an audit plan. You need to know what goes into that audit plan. You need to be able to develop an audit plan for a specific account. And then you also need to know how to respond to risks at a financial statement level, not just at the assertion level, which is where we develop the audit plan. Okay, but before we get into that, let's recap what we've done, because all of that helps us to respond, because we need to know what those risks are. So, what have we done? Where have we come from? I don't just want to jump into the new topic. I want to prep you for it. We have gone and understood the entity, its environment, including internal control. And through that understanding, we then developed our strategy, where we calculated materiality, 2 types, but we're only using the performance going forward. And then, because we had that, we were able to identify risks of material misstatement, material in excess of that performance materiality, at 2 levels, at the overall financial statement level and then at the assertion level. So it was our understanding of this business that allowed us to pick up the risks. Now we need to respond. Guys, we have touched on responding as part of our audit strategy already, because remember, our audit strategy ultimately allowed us to manage our resources or adapt our resources based on the risks and the materiality. And we're going to see today that responding at a financial statement level is all about that adaptation of the resources. Okay, so ultimately this has been addressed. We just cover the standard now dealing with that. But then we need to respond to the risks at the assertion level. So this is responding to those first risks at a financial statement level. Now we need to respond to the risks at an assertion level. And that means we have to develop the audit plan. Okay, so as I always do, I ask you a question. Why do we need to develop responses? Why are we required in the planning stage to do this job? Because our audit objective, the purpose of this audit, is to obtain reasonable assurance. And reasonable assurance means I need to actually get evidence through performing procedures to back up my opinion about whether the financials are free from material misstatement, and therefore prepared in accordance with the applicable financial reporting framework. So I have to develop responses now, because this is actually what I need to go and do to be able to express the opinion I want to express. In other words, developing my responses is going to help me to identify if the risks of material misstatement did materialize into material misstatements. And here's the word that's missing, and that is the risks. Did the risk that there could be a material misstatement actually materialize into it's no longer a risk? There was a material misstatement in the financials, and I need that because of my opinion, which is to say whether they are free from or include material misstatements. So if we're looking at our objective again, let's look at the whole risks around the audit again. Audit risk is the risk that we express the incorrect opinion. Actually add up here. This is the risk that we express the incorrect opinion. So ultimately, there were material misstatements and we said they weren't material misstatements. So we need this risk to be low. It must be low. We want to express the correct opinion. And so we need to first identify where the risks of material misstatement lie, which is the inherent and the control risks, which we got from understanding the entity and its internal control. And then we need to, as a second step, perform procedures to see if those risks materialize. And ultimately, guys, that's the detection risk. This is the risk here that we don't identify material misstatements. How would that happen? That would only happen if we didn't identify the risk up front. And so because we didn't see a risk there, we didn't eventually see that it materialized into the misstatement. So audit risk, the risk we express, the incorrect opinion, is made up of two elements. One, the risk that the financials are misstated and then we don't pick up those misstatements that are no longer risks, they have materialized and we did not identify them. So this detection risk means that in order for us to keep this low, once again, we want this to be low, we need to perform procedures to make sure we find out if those risks have materialized. And so our detection risk and our audit risk is always going to depend on what this risk of material misstatement is. If it's a high risk that the financials could be materially misstated, then we as auditors must have the lowest risk that we don't detect those material misstatements. And how could we have the lowest risk that we don't detect them? We perform more audit procedures so that we pick up material misstatements. And if we think the risk of material misstatements is low, we think these financials don't have material misstatements, then we could allow for the risk that we don't pick up material misstatements to be a little bit higher because we don't think there are misstatements anyway, in which case we would perform less procedures. But if we need to perform more procedures here, guys, then how would we do that? We would need to increase our samples, increase our tests, and how do we do that? We decrease our materiality. If we have a lower performance materiality, we are going to have to add more tests in. More balances or transactions are going to have a risk of being materially misstated because it's a smaller figure that we're looking for material misstatements as. So we will have more work with a lower materiality. Okay, so guys, why am I showing you this? Because I'm showing you that the risks that we've just identified and assessed last week, in week 3, are going to affect what we are going to do in terms of our plan. They affect our detection risk, which is how we need to respond to those risks. It's the auditor's responsibility to ensure that they do identify if those risks have materialized. And that means we need to respond. So detection risk has got to do with our response. Response to the risks of material misstatements. So how are we going to respond? At a financial statement level, we respond to those risks by adapting our resources. So guys, remember, once again, when we looked at planning, we said in part of the audit strategy, we need to calculate materiality, identify the risks, and respond at a financial statement level. And remember, we said the audit strategy helps us with our resources. So ultimately, responding at a financial statement level by adapting our resources is going to ensure our strategy has been adjusted for the risks at the financial statement level. And then responding at the assertion level, guys, those are the specific risks for your accounts in the financials. Specific risks for revenue, specific risks for PPE. So when I respond to those risks, I have to develop an audit plan for each of my class of transactions and account balances in the financial statements. And guys, that is now where detection risk comes in. We need to respond to those risks in detail. We develop our plan. So let's start with responding at the financial statement level. How are we going to adapt our resources to respond to the risks that the financials could be misstated? And I've said to you, ISA 330, paragraph 5, A1 to A3 tells you how to do that. And it's very simple, guys. We need to Maintain professional skepticism. Tell the team, guys, be more skeptical here. Management integrity is lacking. So they could be manipulating anything. Be skeptical when you start auditing. I'm going to get more experienced staff because there's big risks in these financials. Multiple items could be misstated because of these risks. So let's get more experienced staff. I'm going to increase supervision. More manager, more partner presence on the audit. Increase the unpredictability in our audit procedures. So choose different accounts to test. Select different samples from what you would do to be unpredictable so that they can't assume what we are going to do and amend the details accordingly. And then, as a final thing, we will make general changes to the nature, timing, and extent of our audit procedures, which means we will make general changes to our audit plan for the specific balances and transactions we feel could be risky. So look at that example we just did where we said listed, there was a risk at the assertion level for revenue because there is a specific revenue listing requirement. That risk at the financial statement level being listed now makes me realize when I come to auditing revenue, I need to change my initial audit plan for it to incorporate that additional risk that I found at the financial statement level. So what does that mean? I would probably change my timing to do more of my testing at year end. I would probably do more substantive, and I would increase the number of locations I test. That's just an example of general changes. It's not going to be specific, but it's just that you make a note here. I will change my audit plan based on what these risks at the financial statements are telling me could affect that balance that I need to be auditing. Okay, so let's try and do this a bit practically. Let's look at some examples of risks at the financial statement level and then give some examples of responses that could address those risks. Example 1, if management is lacking integrity, it means we think they could misstate anywhere in the financials. So we could respond by increasing professional skepticism. Question things, question balances or transactions. Or we could be more unpredictable in the way we conduct the audit. Choose different balances and transactions, different samples, so they can't predict what we're going to do. If there are additional industry regulations, how can we adapt our resources to address that? Well, maybe we need more experienced staff who are able to handle new regulations. Or we get experts who have that industry knowledge. If they have a new IT information system, so that's a huge part of their internal control and it's changed. We can adapt by getting more experienced staff. They will be able to pick up where the risks lie in that new information system. Or once again, we get our experts. More supervision from management of the audit team is going to be crucial in this situation. Okay, guys, we can also now go and adapt our audit plan. Because if you think about it, if there's an information system that's computerized, we might not be able to get documents to perform substantive testing, so maybe we want to go and test the controls in that system. Okay, we'll discuss that when we do IT at a later stage, but it's just an additional response because our plan will change as a result of how we are able to get the audit evidence. If management receives a bonus based on profit, there's a risk they're going to overstate income items and understate expenses in order to get that bonus because profit will be increased. So, as auditors, we can increase our professional skepticism, be more questioning of other income items or expenses, be unpredictable in which class of transactions we test. So they get used to us testing revenue and interest. Now we're going to add rental income, even though it doesn't look like it's a significant account. Okay, so we can change our audit plan because we pick up there could be risks elsewhere. If they have decentralized operations, more branches, so I'm going to get more supervision. Or I'm going to change my audit procedures so that I am a little bit more unpredictable in where I go and test. So they can't get used to me only testing the warehouse with most of their inventory, because they could be doing dodgy things in the other warehouses. Okay, so it's decentralized operation, more supervision, more staff even, just to make sure I can test more and see the controls are working all over. Okay guys, these are just some examples that I've just come up with. You could come up with your own adaptation of the resources that, provided it addresses the risk, it's fine. It's all about motivating the adaptation.